Hello and welcome to Scale by Design. Today we are joined by Ross Wolfe. Ross, welcome to the show, man.
Hey, thanks for having me. I'm happy to be here.
Yeah, we're happy to have you. And could you share with us a little bit about your background?
I've been in the investment venture capital space for about 14 years now. I was in-house counsel for the largest venture capital fund east of California for several years. And in that, I worked in tandem with the investors and the founders to be a liaison between what the investors are looking for in their deal terms and what the founders can do to position their companies and restructure their companies to be attractive to the investors who are looking for the companies like the portfolio companies. Then I spun off to Diab Venture Partners, which is where I am now. And we're a strategy firm that law firms hire my firm and consulting firms hire my firm and founders hire my firm to help founders structure their companies, position them appropriately for the round for the investor, so they're able to raise capital they need and scale in any round that they're looking to raise money in.
Okay, cool. And so I think you mentioned that it's kind of a wide range of I guess like growth stage startups and growth stage companies. Is there like one area you're a little bit more weighted toward, like as in more so early stage or late stage, or like where are you primarily focusing your time right now?
Right now, most of transactions are in the early stage companies,
Cool.
pre-seed to Series B, and that's to do with the current economic environment and the pressure investors are getting from their limited partners to find companies that are getting returns. We'll touch upon unicorns and dragons a little later here, but generally the shift of what we traditionally identify as the venture capital investor space is happening now, and what we traditionally see as the pursuit for the unicorn is shifted to the pursuit of the dragon.
Gotcha. Yeah, I'm excited to jump into that. So I know we want to talk about market trends, but maybe you could just like talk about the concept of a dragon and what you're referring to there, just for our listeners that may not be familiar, like founder CEOs. Like I'm sure VCs are going to get it, but there's going to be some people out there that probably need to learn a little bit more about what that is.
Yeah, no, we're familiar with what the unicorns are, a company that investors invested in and then they break $1 billion valuation. But a dragon is a company that returns the entire value of the investor's investment back to the investor by itself. What that means is if I have $1 to put into the market, I put 10 cents in the dragon and 90 cents in other portfolio companies. The dragon by itself gets me back my full dollar. So the other portfolio companies that that I put 90 cents in bring me back profit above what the dragon provided. So dragons are different than unicorns in that they are a highly powered growth with more investment rounds and milestones that are more quickly reached than unicorns have been. And dragons have a lot of rounds. But the benefit of a dragon now is that because the economy is uncertain for a lot of people, investors and their LPs want companies that give returns now rather than later.
So is that like, from an investment strategy perspective, are companies, do VCs look at their entire fund, like could each investment we make potentially return the value of the entire fund? Like is that part of like the investment thesis that VCs look at? Like, hey, we're not going to make this investment if we don't think it could cover the entire fund.
Yeah, and the shift of the philosophy is changing for the last 10 years. What we normally saw as the spray and pray mentality, where there's 10 companies and then the investors or VCs just throw money into all of them and hope one of them is a unicorn, has changed. Now we're seeing that if there's 10 companies, the investors and VCs want 8 of them to succeed, and they try to ensure that by being on the ground with the companies to be more like advisors, mentors, coaches, rather than just the spray and pray where here's your money and figure it out. So that's part of what I was doing when I was at the fund. The investors had their deals they wanted to do and we were doing the deals, but in order to make our deals hit the milestones we were trying to hit, I needed to be on the ground with the founders, restructuring the processes, the protocols, defensive protocols, control protocols, economic protocols, all the things that are overlooked by founders in the early stage. And there's different aspects of an early deal that if missed early can cost founders millions down the road. One of those things is different share classes, for example. I see too many times where there's only one share class being transacted, the founder class, but that has all of the same powers as the founders do. But you don't want to do that. You want to allow for diversity in your share classes. So investors come in, you still have some control over the control of the company. And you have different share classes, usually called preferred share classes. So that's
So is there like an investor share class? What about like for stock options or RSUs? Is that also a different share class than founder and investor, or is like the RSU and stock option share class the same as investor class? Like, how do you structure that?
They're different. I create different share classes for each of these aspects, and I'm alone in a lot of it. I'm a maverick in this area where I feel we create a B class, for example, which is just for employees and advisors. But in that, instead of doing RSUs or stock options, which are restricted for the employee, you can't sell them in a private company by Rule 144. They're stuck with it for a year. They may never cash it out. The incentive for them to stay may or may not be enough to have them stay in the company. So what I like to do is create the B class, for example, and have that non-voting rights, but then tie into it what's called a phantom plan, which is essentially an annual cash bonus based on the value, pegged to the value of the share class. All share classes have the same value as a company increases its valuation every year, but they're able to then every year, the employees are able to then get cash based on the fair market value by hitting certain milestones in their performance.
For sure. So, but in that model though, like let's say if you're a hypergrowth company, right, and you're operating at a loss, or if you're like me, you're hypergrowth, but you're bootstrapped. So you're operating on, probably relatively thin margins, enough margin to build cash balance, but you don't necessarily want extra cash taken out of the business. That's like the one thing I think about, right? Like if you're hyper growth, like, do you really want cash bonuses going to employees every year when that money could be reinvested in growth? Like, I'm just curious, like, have you heard that
Sure.
type of
Yeah,
objection?
no.
What are your thoughts there?
And we hedge against that in our structures. We make sure that the fair market value is affordable by the company by hitting milestones. Also, we put protections for the company that if the money isn't there to pay it out, then there's a deferment until there is money to pay it out without jeopardizing the company. So it's an unusual model, unorthodox. I feel maybe I've pioneered it, but I've gotten a lot of feedback and the same questions you've asked. But we've been able to hedge against it successfully and give the options to the employees who just want to cash out versus the ones who just want the money, who want the actual holding of the share class until a later time. But also, if you don't give away the share class and just the phantom plan, you still have those shares you can give to investors instead of further diluting the founders.
Right.
So it has different layers of benefit to the company. That's one thing that I do with early stage companies because the cash is an issue. So
Right.
to make sure that the stock is there to trade and that there's enough incentive for employees to keep performing, I created that hybrid model.
Yeah, that's really cool. And just for to make sure I understand, is phantom stock the same thing as SARs? Like an SAR, just for people listening, stock appreciation rights. Are these like the same things, or are those different? Do you know by any chance?
They are different because by having the phantom plan, you're limited to not the downside, but the limitation of it is it's limited to key employees early on. You can change it to something more traditional later, but by having the phantom plan, you're able to circumvent a lot of the constraints that any kind of option plan provides. So it's similar in the fact that the fair market value, as the fair market value increases, so does the value of the incentive for the employee. But it also provides an option for the payout or to hold, or for the employee to have a more in-depth discussion with the employers, the founders, for a more customized plan.
For sure.
Whereas if you tie it to a traditional plan, it's much harder to change because you have to go through all the filings and regulations to change it.
And I guess like hypothetically, couldn't you just for like a phantom plan, you could put a clause that there's no annual payout, that there's just a collection in the event of a sale? Like could you do something?
That's possible,
like that?
yeah, but it's usually tied to milestones that the employee has to reach before
Okay.
they're eligible to get the payout. So if I've given my team member Class B Phantom plan, they have to meet certain requirements. Otherwise, when the annual assessment comes for the payout, if they haven't met it, then there's no obligation for the company to pay it out. But the company can if they want to. So we create flexibility because we know things happen, employees have issues, and we want to make sure that we provide for them, as well as providing the founders tools to be able to grow and keep the team. Because the team you start with, if you can keep them, are invaluable to the company because they know the history of the company, their loyalty is there, you know how they work. So I prefer keeping people on board, and this way I think creates more conversation between the team and the founders to create something that works for everybody.
Yeah, no, that makes a lot of sense. And I guess my other question would just be, we're talking about fair market value in terms of doing valuation of the business for the purpose of granting, whether it be stock options, RSUs, whatever, phantom equity or phantom options, whatever it might be, to put together a reasonable valuation that's, very lower so that, employees can get a reasonable, I guess, buy into the company. Have you seen situations in which, like, is there any correlation between the valuation done for internal employees versus valuations done to raise capital? Because, like, my whole thought process is it would potentially be you're trying to value at different kind of ends of the spectrum, I would assume. And, like, do investors look at, like, hey, what's the valuation you gave for Phantom or RSUs or whatever, and then expect the same evaluation? Or is it when you're doing a fundraising valuation rather, is it you're also selling the potential, so therefore you're able to have like a higher valuation on the company? Do you know what I mean? Does that make sense?
Yeah, the beauty of venture capital and the personality of those who are in this space is that they're always open to cooperation and collaboration. So yes, in some cases, the 490 valuation of the incentive plan is considered, but then so is the value, overall fair market value of a traditional valuation by a third party evaluator. So, and all those things are points of negotiation between the founder and the investors. Or what I like to do is actually create the actual offer, whether we're going to consider the 409A valuation, the incentive valuation, or have an independent third-party valuation, and then use that to be the status quo of the round. I don't like to have too much diversity and too much favoritism, because then in VC, you're working with some of the biggest hitters and players in the world, and they're very, very smart. So you want to make sure that you're fair, because if one of them gets pissed off, then that could cause a ripple effect that could be detrimental to the company. So I'll try to be as fair as possible by identifying exactly what is going to happen in that round, who gets what. And of course, there's room for side letters of someone who's really influential, who's really important to the company. But I like to pick what we're going to do before. And to your question, it could be anything, but it's up to the founder, I think, in my humble opinion, to present what the offer is to investors. And if the investor gives pushback, reevaluate, iterate, and come back with something that will work for that round of investor, because each round has a different character or personality of investor.
Right.
So every one of those points is open for discussion, and that's the beauty of VC.
But I guess, like, so that makes a lot of sense. But, like, in terms of, is the valuation that employees get to buy into these programs, whatever equity programs it might be, is it the same valuation that the VCs are buying into the company?
If it's a stock option purchase plan, then they have a strike price. Okay. So they can exercise that strike price whenever that time comes. And it usually is more favorable to the employee.
Okay, but that's kind of what I was asking. Like, yeah. Is that common for it to be, like, I guess, more favorable? Or
it can be, yeah. Usually strike price is what is there to make it more affordable for the employees, because they're not accredited investors necessarily. So they need to create something that's affordable, and a strike price. They buy the right for a strike price that's favorable down the road.
Yeah. Okay, cool. Yeah, I know, like, we wanted to talk about trends and stuff, but, like, we started talking about what your firm does and how you're helping founders and CEOs. And so I wanted to kind of follow up on some of the things that you had mentioned. So that was really cool. Thank you. And that was pretty technical too. So I think people listening in, like we have, you know, a lot of our guests too are founder CEOs and people tuning in too. So I know that's like just highly valuable content for people tuning in. Um, so hey, look, like in terms of, let's just jump into trends, right? Like obviously the market is insane right now. I'll just tell you from my perspective what I'm seeing. So my company, Secure Vision, basically tech companies borrow recruiters from us. So we're helping, you know, startups, growth stage companies, hire everything from engineers to salespeople and everything in between. And so we've worked with over 150 companies in the past 7 years, and so we have, you know, a fair amount of experience doing this. And this market is definitely like, it's just weird. Like we've seen, what I think one of the biggest insights that I've seen is that our lead activity, it is, I think recently it's going down, but the weirdest metric that we're seeing is the conversion rate from verbal commit to closed won deals. So we're getting a lot of tech companies saying, hey, we're ready to move forward and hire, send us your agreement. And then like 2 days later say, oh, give us a week. And then basically pulling out of the process. We used to have like a probably close to around an 80+% conversion rate from verbal accept to closed won. Now it's under 50% because people are so uncertain in the market. So it's like at this point, when somebody verbally commits to move forward with us, I'm like, well, all right, I'll see, you know, when we see the signature, we'll believe it. Right. So it's just a very interesting dynamic. Everybody's like really scared right now. I've been talking to like a lot of advisors and heavy hitting people. I'm like, are you hearing anything optimistic out there? And they're just like, nope, there's no optimism. People are just, it's doomsday. Everything is awful and it's only going to get worse. So I'm kind of curious, like,
Yeah.
you know, what are you seeing out there? Like what trends are you seeing in the VC market and in fundraising right now?
I'm seeing a golden opportunity for founders to get ahead of their competition. Main Street's saying, save your money, don't spend, wait till things get better. But that doesn't make any sense, because if you are in a highly competitive industry or a mildly competitive industry, things are at a discount now as far as the valuations are concerned. And if a founder invests appropriately into their R&D, business development, growth, MVP, minimum viable product, the product that is not perfect, but it's available to show to investors, then investors now are looking for those deals better than the later stage companies, because later stage companies have grown stagnant lately. And their investors are getting pressure from their limited partners to get returns. So they're not investing anymore into the later stage companies because they need to continue reaching milestones, and they need a high octane portfolio company in their portfolio. And that is coming from the early stage founders. So it's a very exciting time for early stage companies, series pre-seed to series B, to really get in front of investors and show them that there is opportunity here to scale powerfully together. There's a shift in where investors are putting their money. Domestic investors and VCs are going overseas because the markets over there are not as in flux as the markets over here. But then we're seeing the re-emergence of corporate VCs, CVCs, that have been dormant for years, but now they're coming back on the field and replacing the domestic investors temporarily by looking for and capturing early stage companies that complement the corporate VCs long-term model. What I mean by that is, if you are, just an example here, if you are in food tech and there's a company that's established in food tech, if you're creating your company to fit a gap that's missing in that larger food tech corporate VC, then that corporate VC is actually giving favorable terms to the early stage company. And in some cases, I have seen that they're putting angel investor terms in a corporate VC investment. And that's huge. That's a huge game changer, because you have the backing of a corporate VC with the mindset of an angel investor. And all they want is for your early stage company to continue to grow the way you're growing and fill a gap that they have now. Because when the markets start recovering more, they will have your early stage company integrated into their larger company, and then they are ahead of the other larger companies that are
Right.
competing against them.
It's more of like a strategic investment to fill a gap that's going to make, put them ahead in the greater market, for maybe, yeah, like a
Yes,
larger portco or whatever else, right? That's basically the
yes,
objective of a CVC. Is that
correct. And
okay?
the mentality that some founders may have, that a lower valuation makes it bad as an investor, is wrong. Because if you go into the over high valuation, and then next time you have a down round, you could lose control of your company in one round. We're seeing the re-entrance of terms that are called full ratchet, anti-dilution terms. And what that means is, if the valuation of the company goes down, then instead of giving more money, or the investors losing out, the investors convert the money they put in into the new value of the stock, which means if I put $1 for 10% of the company, and then I have a 50% down round, then I now have 20% in one round. And the worst case scenario is if I've come in at 25.5% as an investor, and then you, a founder, thought you had 74.5% of your company. You have a down round, a full ratchet gives the investor 51% of your company, and you are at 49%. Just like
Yeah, that's yeah. And so I mean, there was companies in Q4 that were celebrating massive valuations. Like we, starting to hear the term unicorn all the time. And, we were seeing companies, from my understanding, like very low in terms of ARR, like maybe 1 to 3 million, getting insane multiples on their ARR. I heard in some cases like 60 plus. I don't know if you heard that, but just insane valuations. Companies that are just pulling in like a million or two, getting, being valued at 100 million. And that sounds very exciting, right? But then it's like, well, what are they supposed to do now, right? Like,
exactly. So celebrating high valuation, you're saying, is not something that I would encourage these days.
right?
And I
Like,
always advise to under promise, over deliver, and just get a valuation that makes sense. So if you've been around for 2 years as an early stage company and you're valued at $7 million, that's fantastic. When you put in 1,000 to start your company, right? And now you're at $7 million 2 years later, great. And then if your corporate VC comes in and says, hey, we want a deal, really consider it, because that's going to be the best for everyone. Make sure you keep control for a while, as long as you want to stay, and that you have protection so you don't get just fired. But it's much more exciting, this economy, in this industry, in this time period, to have a reasonable, practical valuation than to come in pie in the sky and say, yeah, we are the best because our numbers, our valuation says we are. But then the next round, you've jeopardized everything you've worked for, and you might lose control of your company.
so then what do you think the appeal is to get that massive valuation, like to push for that massive valuation? So like, let's think of the minds of founders, CEOs, COOs, just, co-founders, whatever, in Q4, were the VCs pushing partially for these massive valuations so they could get terms in like full ratchet so they could get potential? I mean, what drives those large valuations? I mean, obviously demand in the marketplace, but wouldn't potentially someone similar to yourself advise companies in Q4 to say, hey, well, there's potential downside to raising at such a huge valuation? And why
Yes.
are people running after that so much versus like thinking more so within possibly reason, like, hey, we don't need to raise so much money, or hey, we might do a little bit more, but this is going to set us up for success in the future?
So I always advise my clients to under promise, over deliver. And if they insist on coming with a higher valuation than I think is practical, I just don't take that round. And I encourage them to go somewhere else, because the downside is too traumatic, too dramatic to get behind it. But the reason people come into the high valuation is by the mistaken belief that bigger is better in all cases, but
Right.
it's not. Because economically, practically, financially, business-wise, and I was a founder, so I know how things work, and I've had exits myself. I know how things work. I know how companies scale and grow. I've been there. I've seen how it works. And you don't go from 2 million ARR over 2 years to $100 million valuation unless you have some amazing new IP that has never been seen before. That's
Right.
possible. Or you have a very influential board member who will ensure that your growth will and scale and trajectory that will justify that in years. But there is no shame in saying, yeah, well, we have a great ARR, but you know what? We're not worth $100 million right now, but we're worth 10, 15, and we're still attractive and we still are able to grow and we're realistic. And investors now and CVCs are much more responsive to that because it shows responsibility on the side of the founder.
Right.
And now I'm seeing my colleagues walk out of pitches by founders when the founders are overzealous in their valuations.
Yeah, that makes a lot of sense to me. So what do you think about, so Crunchbase posted an article. Now this is actually more so referencing Q2. So I'm curious if you have any updates on Q3, what you're saying, but they're looking at like second quarter funding fell 26% quarter over quarter from 162 billion in the first quarter, and 27% year over year. So it looks like the VC market is contracting. I mean, it does sound like there's obviously a lot of opportunity from what you're saying for early stage founders, but there's definitely pretty obvious contraction, right? Like Q4 was massive, Q1 was less, and then Q2 shrunk more. I don't know. Like, is Q3, has that continued to shrink down, or where do you think it's going to fall in terms of the trend for Q3?
64% of all new investments have gone to early stage companies. So the fall that we're seeing is not in pre-seed to series A or B. We're seeing that in C, D, E, F, G, where the companies have gone more stagnant and they had milestones they're supposed to hit, that they're slow getting there, or they're not going, even if they hit the milestones, they're not going to grow at a 5, 6, 7, 8, 9x that they thought they were 2 years ago. So they're going to feed the winners and starve the losers on the investor side. And if a company that's later stage has gone less with less velocity, then they're going to shift focus on the early stage. And we're only seeing that primarily in the US, but a lot of investments are going to India, going into Asia, and going even into Eastern Europe.
Right.
And that's increasing. And there's new funds being created in India and Asia that are specifically, and the Middle East, Dubai, that are putting money into early stage or middle stage or later stage companies in those regions. But the phenomenon about the contraction is mostly a US isolated phenomenon because of the economy.
Yeah. I mean, so just to speak to your trend in terms of what I'm like reading from the Crunchbase article, it does seem that early stage funding, it is contracting a little bit, just not at the rate that the overall market is contracting, the VC market. So it's
the
going.
Deal size is getting smaller. The deal size is getting smaller, but the amount of transactions is increasing, which makes sense because you don't want overvaluation. So the deal size is getting smaller.
So it's more like the transaction. So maybe there's slightly less money circulating, but there's still a lot of investments happening. Like that's
more
that's
deals
what it
than
sounds.
last year. More deals than last year, early stage, but less money in that range.
Right. Okay. Well, then that makes sense because that's basically what the Crunchbase article is saying. It's like early stage from just a dollar amount, not like a transaction amount, is going down in early stage, just not at the same rate that it is in the overall market for larger stage investments. So that makes a lot of sense. You know what's interesting though, is you said you were talking about international investments moving out of the US. We've seen an increase in we have a great relationship with Prosus, international investment firm VC that I specifically have a great relationship with Prosus India. And so they refer customers to us, and we have a great partnership with them. And so basically have been very active with Indian-based companies that are building go-to-market teams in the US. So what's really interesting is like how you're talking about US firms going international. Is it just that like globally people are trying to diversify? Because I've definitely seen an uptick in Indian-based companies that are signing up with Secure Vision right now. So yeah, I'm just kind of curious to get your thoughts on what's happening.
Yeah, that parallels what's happening, because the part of the growth generator of the foreign companies is a US market. You have to have a US market if you're going to scale at any competitive rate, no matter where you are in the world. And if the companies that are opening headquarters in the US have a fiscally reasonable product, something that makes sense, that's not unaffordable, because people are struggling now paying think egg prices are up 20% or 40%. Turkey prices are up 25%. So people are struggling to afford the everyday thing. If a company from overseas can come with a product cheaper, which they can because labor overseas is cheaper, then they will have more volume in the US, which will meet the mentality of the US consumer now that wants something less expensive. So what's happening to you parallels exactly what's happening in the investment market. And that's the beauty and excitement of investment in venture capital. Everything that happens in venture capital and investments in the early stage impacts the entire world. And then you see the impact of the work that you do as founders and that we do as advisors actually affect people's lives in the world in a positive way. And that's a magical thing to be a part of. So if you're a founder having a hard time, then the last thing you should do is give up, because if you believe in your product and you know you have consumers, then keep at it now. So I'm going on a tangent, but I mean, this is something that I think founders need to hear, is that this time can be seen, you have a choice to see it as a tragedy or as an opportunity. And all trends point to opportunity if you play your cards right. But to your point, yes, what's happening from overseas movement in the US parallels the industry, the VC industry.
I think you might have touched on this, but just so we can slow down on this point. Maybe some of these firms in India do have an advantage because their product teams, their design teams, their engineering teams are based in that market. And now they're getting a ton of money, massive investments from companies like Process to come to the United States and build out their go-to-market teams. Whereas a lot of the tech companies that are still headquartered in Silicon Valley are paying, $200,000 a year for engineers. So maybe there's an advantage there where, they have more budget for Google Ads, demand generation, really just pushing product development at a rate that a lot of the earlier to mid-stage US-based companies are not able to compete with. Like we've had some late-stage customers that are, pre-IPO, at least they were last year. I don't know if they're thinking about it now, but we were working with some late-stage companies that I won't name names, but one large customer, category leading SaaS company in the fintech space that was hiring, around 500 to 1,000 engineers in the US based market on an annual basis. And things really started drastically changing Q1. And so basically they cut all hiring in the US and they shifted gears to hiring in primarily Eastern Europe for their engineering talent. But that's a huge shift to shift such a large workforce and also maintain quality control and efficiency and maintain your competitive edge in the market versus potentially a competitor that has their entire tech infrastructure in India and only has to focus on building a probably somewhat, small to medium sized go-to-market team in the US and then just dumping a ton of money into demand gen. So I think maybe that's that kind of like I don't know, but I would assume that's like some international investors are thinking of that as in terms of their investment strategy this year.
100%. If I could put $1 in a foreign company and have a cost that's substantially less than the dollar that would incur in a US company, and then the return on volume based on the dollar I put in is exponentially higher than what I would get in the US market, that is why investors are going overseas. Now, they're not going to stay there, but they're going there now because they want to get a foothold on what you're exactly to say. The companies that are intelligently and smartly exploiting the benefits of being less expensive to produce in their market, but then the cost of purchase here is on American market standards. So all that is extra buffer on the operating capital of the foreign company.
Yeah, I got a couple of incredible clients that they're around 200 to 400 headcount in India. They got a killer product. They're not wasting any time moving headcount to different regions. Yeah. They just got a shit ton of funding this year and they're going to crush it. And it's just, and then you got the clients of the US that are trying to make the other transition. They're not focused on strategic growth. They're not necessarily able to as much so focus on the customer. They're focusing on how do we cut costs? We have too many, can we avoid layoffs? Do we have to do layoffs? How many layoffs are we doing? Wait, how do we ramp up an engineering team in Eastern Europe or India or LATAM? I mean, it's just a totally different, the strategic leadership is focused on totally different problems. One's focused on growth, one's focused on survival. So that's an interesting point. I'm glad we kind of fleshed that out, because it makes a lot of sense, right? In terms of that.
Yeah. In the end, everyone's going to benefit. US, overseas, investors, LPs, founders, they're all going to benefit. But in the meantime, that's what we said at the opening of this segment. Putting your resources now into making your MVP better, your R&D better, putting your money in now instead of holding it and saving it like you're hearing on Main Street to do, that's where you get your competitive advantage when the dust settles. So I will say this over and over, and I've said this on my videos that I do on my social media. If you're not putting money into your company now as an early stage founder, you are missing an historic opportunity to get ahead and scale that we haven't seen in 15, 20 years.
I love it. And Ross, we're coming up on time here. So we're probably going to go ahead and just wrap up, but this has been an incredibly valuable episode that I'm going to share with all my founder CEO friends. And I know venture capitalists as well are going to love tuning in, and there's probably going to be a lot of shared experiences. And I know some people listening are just going to be saying like, yes, like it makes a lot of sense. Right. So thank you so much.
I get blowback too. I get people who disagree with me, and that's okay.
Yeah, okay. Sure. Hopefully we'll get some of that too. You want it to be a little bit controversial. That's what makes it fun.
But in the end, I know I'm right, so it's okay.
Right. Yeah. So they can say what they want. Yeah. Like, good point, but I'm still right. Yeah. Well, hey, look, Ross, if people want to engage with you, what's the best way to do so? LinkedIn, your website, like where do people go to find you?
Sure. Instagram, we're at Diab Venture Partners. D like David, IAB like boy, Venture Partners. On LinkedIn, Ross J. Wolfe, Diab Venture Partners is there. Not much Facebook presence because that's more of just a social thing. Also my email, rj@diabventurepartners.us, and my website, www.diabventurepartners.com. So I do hope that I was of value to you and your listeners, and that something that I've said today has made people rethink their position and made them a little more motivated to take advantage of what's happening now. And I'll say this one more time. If you have had a hard time as a founder now, the worst thing you can do is give up, because you started your company because you believed in the product you're going to deliver to the public, and you believed you were going to help people do it. So if you give up now, you're not giving up on yourself, you're giving up on those people who can benefit from your product.
I love it. Well, thank you, Ross. I really appreciate you coming on the show. And we're going to have to do this again sometime because it was packed with so much value. And for everybody else tuning in today, thank you for joining us, and we'll see you next time. Take care.
And I got to say one more thing, capitalize.
All right.